Hey, good morning. This is Elston. Actually, good afternoon. This is Elston with Lifestyle Evolved. And today I wanted to go through a report that I received in my email. And it comes from the asset management company called Bitwise. And they published this report. It's titled The Case for Crypto in an Institutional Portfolio. So it goes into the table of context here. And it shows, crypto's impact on a 60-40 portfolio. So what they start off with first is just talking about the purpose of this report. And it says this paper revisits the case for adding crypto assets to a diversified portfolio of stocks and bonds by updating the data used in a paper with the same name published in May 2020. We consider the impact that different allocations to crypto assets would have had on a traditional portfolio consisting of 60% equities and 40% bonds under a myriad of different market regimens. The findings continue to be remarkable. The paper shows that crypto would have contributed positively to a diversified portfolio's cumulative and risk-adjusted returns in 100% of the 3-year periods, and 97% of 2-year periods, 77% of 1-year periods since 2014, assuming quarterly rebalancing. In addition, the size of that positive impact has been significant. Assuming quarterly rebalancing, a 2.5% allocation to crypto would have boosted the median 3-year cumulative return of a traditional 60-40 portfolio by 13.3 percentage points. So you can see a small allocation to crypto really did help out the overall strength of your traditional portfolio. Counterintuitively, crypto has positively impacted portfolios even over periods in which crypto's price has declined. For example, an investor who initiated an allocation to crypto at the precise top of the 2017 bull market on December 16, 2017, would have seen that allocation begin to contribute positively to their portfolio by June 17, 2019, despite crypto still being down 52% at that time. This remarkable result is driven by the fact that crypto has low correlations with other asset classes in daily liquidity, allowing investors to capitalize on the volatility harvesting opportunity that non-correlated assets offer. The paper builds on a significant existing literature examining crypto's influence on portfolio returns. One criticism of prior papers, however, is that the authors cherry-pick specific time periods, rebalancing strategies, or allocations to highlight positive results. The question that lingers in the back of many potential investors' mindsets is, but what if I didn't allocate exactly this way? So this paper aims to address this type of question by being comprehensive in all possible aspects. Specifically, it shows how key portfolio metrics would have fared considering extensive price data, considering prices from January 1st, 2014, all the way to June 30th, 2021, all available time periods using rolling period analysis to examine every possible 1, 2, and 3-year holding period within the history, a range of potential crypto allocations from 0 to 10% of a portfolio, and multiple rebalancing frequencies, including monthly, quarterly, annually, and then also no rebalance at all. So these are all of the metrics that they share in this report. You can find this on the bitwiseinvestment.com website. But I just wanted to go through a little bit of it here and show you some of the findings that they found. It says that this paper examines the impact of adding a crypto allocation to a traditional diversified portfolio of stocks and bonds. The traditional portfolio features a 60% allocation to the Vanguard Total World Stock ETF and a 40% allocation to the Vanguard Total Bond Market ETF. VT holds a market cap weighted portfolio of global stocks covering 98% of the world's market capitalization, while the B&D holds the market value weighted portfolio representing all taxable investment grade U.S. bonds. The paper focuses on a period between January 1st, 2014 to June 30th, 2021, therefore removing the first 3.5 years of Bitcoin returns. The decision to remove those years is in an effort to not skew the massive gains that happened throughout that time, because I believe that Bitcoin went up, I think it says here, right here, it says for a cumulative return over the roughly 3.5 year period that was excluded, it went up 1.5 million%. Whereas if we start here, Bitcoin's returns were 506% in 2010 through December 31st, and 474% in 2011, 186% in 2012, and 5,537% in 2013. Importantly, the paper takes advantage of both point-in-time and rolling analysis. Aside from cumulative and annualized returns, this analysis also delves into the key portfolio performance metrics like Sharpe ratios, standard deviations, and maximum drawdowns. This shows here, it shows here pricing data used throughout the study was sourced from IEX Cloud for traditional assets and from Bitwise Asset Management, its internal database for Bitcoin. So let's go into the right here. It shows some overall analysis here, and it says the impact of adding crypto to a 60/40 traditional portfolio, how adding Bitcoin to a traditional portfolio would have impacted returns. So it says we begin the study with the classic 60/40 traditional portfolio, initially without a crypto allocation. From the start of our primary study period on January 1st, 2014 until June 30th, 2021, the portfolio returned 74.72%, which translates to an annualized return of 7.75 per year. As the chart and the table show below, a modest allocation to crypto would have significantly improved the returns. So here's the chart. And this chart shows you a 1% allocation in green, a 2.5% allocation in the darker blue. The lighter blue is 5%. And then you have your traditional portfolio in the gold. And this goes from 2014 all the way to almost current time to 2021. A nice thing is that it takes into account the massive growth that happened between 2020 up until about May of 2021. So we go through that volatility to where the price actually decreased by 50%. And it shows here, for example, adding 2.5% crypto allocation with a quarterly rebalancing would have improved the cumulative return of the portfolio from 74.72% that you got in your traditional portfolio up here to 112.73%. Importantly, this result would have been achieved without significantly changing either the portfolio's volatility, which you see with crypto only increased slightly compared to without, or its maximum drawdowns, where you see that the drawdown was almost just 1 point from the portfolio with the crypto in it at 2.5% allocation to the portfolio without. Very little volatility there. Still big drawdown, but it happened either way. So it says naturally crypto's portfolio impact would have scaled with the size of the allocation. A 5% allocation into crypto would have boosted the cumulative return of the portfolio to 156.46%, more than doubling the total return of the traditional portfolio. That is a remarkable impact considering the relatively small size of the allocation compared to the traditional bucket. So super cool stuff here. The article continues to go into more in depth into some metrics, such as it shows you a 1% allocation, 2.5 and a 5%. It shows those returns in cumulative, your annualized return, the volatility here, the maximum drawbacks between these, and obviously look, higher risk, higher reward, larger drawback. So it goes into this analysis for generalizing crypto portfolio impacts through rolling analysis. So it says, while studies that focus on a single point in time are illustrative, looking at rolling periods gives a further understanding of the impact of crypto allocations on a traditional portfolio. So it shows you down here that during the 2017 the entire time frame is 2014, January 1st to June 30th, 2021. It shows you what your traditional portfolio would have been right here in this black line. And then it shows you the green is the positive impact that crypto would have had on your portfolio with those allocations. And then you can see that it also puts a metric in here that doesn't even show up because there was no negative impact comparatively. And so, I mean, this report is it is not made for retail investors. They specifically wrote this report to present to institutional investors. When I get this email, it says not for retail. This is for institutions. So I will leave a link to this report in the description of this video. And then if you have any additional questions, obviously please leave a comment, like, subscribe to this channel, as we're going to try to continue to produce relative and important content and make sure that people know what's going on and where this financial infrastructure is going. So everybody have a great day. Oh, I don't want to cancel. I want to